Good morning, everyone. Well, the currency wars are over. At the G20 meeting, FX was not the contentious issue it had been at the previous G20 meeting. The section in the communique about FX policy was basically the same as in February, except for two new sentences. Monetary policy should be directed towards domestic price stability and continuing to support economic recovery. We will be mindful of unintended negative side effects stemming from extended periods of monetary easing. This statement, which calls the negative side effects of quantitative easing unintended, means the QE countries have won the argument over their policies. Loose monetary policy is no longer seen as part of a currency war. Rather, it's considered to be necessary and appropriate for the global goal of fostering the recovery. As a result, Japan not only escaped criticism at the meeting, but on the contrary won praise as a country that was fulfilling its global obligations. As the communique said that, quote, in particular, Japan's recent policy actions are intended to stop deflation and support domestic demand, unquote. Bank of Japan Governor Kuroda acknowledged that this statement was in effect the green light for him to implement what he called appropriate monetary policy, which is code language for further massive easing. We expect this will push dollar yen through the magic 100 number in the not too distant future, perhaps as early as today. If anything, Europe, more specifically Germany, came under pressure at the G20 meeting, as the general view was that Germany, with its large trade surplus, could do more to promote growth. For dollar yen, a break of the 100 mark today may see more investors put on bullish positions. Resistance is likely to come in at 101.65, which sees trendline resistance and the upper Bollinger Bands, as well as the 101.44 high achieved 4 years ago. Support comes at 99.35 and 98.80. This is Marshall Gittler, head of Global FX Strategy at IronFX, wishing you solid trading.